Welcome to Driving Alpha, where we feature our friends, the outperforming investors who demonstrate their path to driving alpha or outsized investment returns. We're Alpha Partners, where we partner with 1,000 early-stage venture firms as their opportunity capital to invest in their best companies. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.
Welcome to Driving Alpha. I'm Sam Silverstein, Vice President here at Alpha Partners. Today's guest is Dave Lambert, co-founder and managing director at Rightside Capital Management, arguably the most active pre-VC stage investment firm in the United States. Dave and his team have a unique data-driven approach to investing in early-stage pre-VC startups. They started investing in 2012 and now have a portfolio of over 2,000 companies. Dave has a long and varied career as an entrepreneur and investor. Prior to co-founding Rightside Capital Management, he founded and ran two successful startup companies, Acorn Computer, a computer company that he bootstrapped right out of college, and Work Metro, an online recruitment marketplace. Dave is a graduate of Stanford University, where he specialized in values, technology, science, and society with a focus in AI. Dave, welcome to the podcast.
Thanks. It's great to be here.
I'm glad to have you. So let's start with your background as an entrepreneur. You have a deep understanding of the challenges and opportunities that startups face. And so I'm curious, coming into venture, what are some of the key learnings that you brought from your time as an operator?
Yeah, I think the biggest thing for me is, as you mentioned, in the 90s, I founded and ran a computer hardware company, and it was a software company in the 2000s. In that, my first one was bootstrapped. Second one, took venture capital from two prominent Bay Area VC firms, and was also an active angel investor on and off from the mid 90s to mid 2000s. So I think the biggest perspective I brought in at the time was that the very earliest stages of raising were dysfunctional, actually, both from the entrepreneur's perspective and from the investor's perspective as an angel. A lot of our thesis coming in was just that it's done incredibly inefficiently and dysfunctionally, and there's just a lot of room for improvement that could improve results on both sides. So that was my big takeaway. When my partner came up with the genesis of the idea and said, hey, here's what I'm thinking, I was like, I felt the pain on both sides of this equation.
So tell me a bit about the dysfunctional aspects that you were experiencing.
I mean, it was a little different then than now. In the 2000s, you could not so easily even find out that VC firms existed. There was not some place you could go online and just download or pay for a list of all VC firms and get email addresses and contacts. How did you find angel investors or angel groups? There's, no such thing as angel list or anything out there. So just finding out who potential investors are, even in your own city, being in the Bay Area, was very difficult. And I think as an investor, the same thing was true. It's just incredibly hard to find companies. It's not like there were some sites or marketplaces. There was no tracking online. It was just pretty much your network that you would use. And then once you engaged on both sides, it was clear to me as an angel and working with other angels and other people and when I was raising from venture, the whole decision-making process and then the way that investors chose companies felt like it had to be sort of almost mathematically wrong. That it was such a bespoke, subjective process that varied so much from investor to investor that somehow it felt there needed to be a better way. And ultimately, it was all about sort of creating a lot more transparency, less friction, and an easier way for high-quality founders to raise capital more easily, which I wish existed when I was raising, and I wish existed when I was an angel investor.
So one of the things that sets Rightside apart is the data-driven approach at the earliest stages. So can you tell us a little bit about that and the types of data you guys are looking at when these companies might just still be napkin phase?
Yes, it varies. So when we started out in 2008 and 9, when we were sort of bouncing this idea around, and this was sort of brain candy for ourselves, the original concept was we understood back then that the entire startup world ran off of power law distribution, which is, a known term now, but it was a completely unknown term back then. And our view is we sort of considered the positive outliers in the tech world to be positive black swan events. So there's a famous book called The Black Swan, which had come out at the time. and talked about these very negative, unexpected events that seemed unlikely in foresight and likely in hindsight. And our aha moment was that most successful tech startups had that same dynamic. They were just positive outcomes instead of negative. And so we started looking at what was needed to take advantage of that. We theorized if you could be the first check-in to almost every tech startup in the US, these big outliers would more than make up for all these massive losses. You can't invest in every company. So the question is, if you did math on top of a power law distribution, how much diversification would you need? So that was the first sort of data-driven analysis, is like sort of the portfolio construction. And then once we did that, then the question was, all right, how do we take the processes that early stage venture capital firms and angel investors are doing right now, and how do we systemize that and turn that into a quantitative data-driven approach? So anyway, that was our initial premise. Our aha moment was when we did the analysis on diversification, and we realized that you needed well over 100 investments to begin to smooth out the risk curve and capture returns with high consistency, and that you wouldn't just need 100 in a portfolio, you probably needed 100 per year to account for vintage risk as well. And we realized that, almost no angel investor, except for maybe Ron Conway at the time, and no venture firm was adequately diversified. And that made us sort of think to ourselves, we wonder if a lot of the best practices that have emerged in venture capital and for angel investors are actually best practices that are not optimal for returns and are maybe optimal to protect under-diversified portfolios. So that was the first time we thought, maybe there's a lot of opportunity here that's untapped. And then when we started looking at data, to get to your original question, the data was very different when we started. Like in 2012 and 13, almost everything we invested in was pre-revenue. So we were looking almost exclusively at founding team and projected business metrics, unit economics. But that's changed dramatically. Like by the time we got to the late 2010s, almost everything we invested in had revenue. So the data that we started pulling from and analyzing was now revenue, cash burn to get to where you're at, unit economics, growth rate. And that's mostly what we're doing.
So you're still finding quote unquote pre-VC companies that are generating revenue that bootstraps, similar to what you did at Acorn Computer almost, and now deciding to enter the venture world.
I think the biggest misunderstanding about what we do is the sort of the pre-VC term. Like by default, people assume that means we're investing at a stage of company development that's much earlier than even pre-seed venture capital. But that's not actually true. It's not an earlier stage. We're not actually investing at the idea on paper stage and haven't for many, many years. What we're investing in is companies raising round sizes that are too small for the professional venture capital world to address, even pre-seed stage investors. So it's really the cream of the crop of capital efficient tech startups. So these are companies in today's world that already have revenue, usually $5 to $30K MRR, but they only need a $200,000 to $500,000. And so it's that small round size that the professional world ignores that we address.
Got it. And do you have ownership mandates for when you make your first check? So you're willing to invest in okay.
That's another thing that's very different about us. For some reason, most of the venture capital world is just entirely fixated on what's the owner percentage. And they have a target ownership percentage of a company going in. And we've never understood why that is. Like we can't come up with any math model that shows why that matters. All that matters to us is our expected return multiple on an investment. And so it doesn't really matter to us. Sometimes we might be investing $200,000 at a $2 million post-money valuation, and we start with 10% of the company. Most of what we invest in is like $2 to $4 million valuations, but we're fine making an exception for extreme traction. And if the company only needs 100,000, we'll put in it a 5 million post, and we start with 2%. Like that percentage ownership is an irrelevant number to us. All that matters is what's our expected return multiple on the dollars coming in.
And how does analysis change as companies start to scale and raise future rounds? How do you guys address those situations?
Well, the analysis, meaning like how do we, when we're projecting that forward, what we think is going to happen, how does that affect our analysis up front? That's actually changed over time. So when we launched in 2012, it was a very different sort of exit world back then. So for the most part, there was not a robust and active secondary market. Most of the M&A activity that happened in tech happened sub $100 million. So in 2012 and 13, we had a much stronger focus on not just capital efficiency at the time that we invested, but that a company had a fairly capital efficient path forward. And we had a little bit of a bias away from things that we knew for sure would go down the venture channel and raise huge dollars. We didn't, ignore those completely, but invested in less. But the exit world for an early stage investor like us has changed so dramatically since then. By the time we got to the late, 2010s, tech companies were buying companies at much higher valuations. The PE world exploded in volume and activity. So private equity firms are buying companies outright at, hundreds of millions of dollars. You had funding rounds now happening in the venture and private equity world into the hundred millions and billions of dollars all the time. And there was almost always more demand for the company stock than supply. So there's the ability to sell into those. So I would say probably by 2015 or 16, we'd sort of dropped that capital efficiency going forward bias as much, because suddenly, at the early years, we wanted to optimize to be able to get a great return off of almost exclusively sub $100 million exits. And exits above that were icing on the cake, because that's where we thought the most liquidity was. In today's world, it's sort of the opposite. There's sort of more liquidity as companies become higher valued for us, because we don't have to wait until the company sells. So there's not still a ton of actual M&A activity relative to the number of companies out there in the hundreds of millions or billions, but it's not offensive at all for any company or later stage investor for some early pre-VC stage investor to sell out at a Series C that's happening at a $300 million or a $2 billion valuation. So it's a very different exit world for us than it used to be.
Sure, I can imagine. Have you built out a team internally to help identify times that you can sell secondaries? Is that something that you address after certain stages? Are there any rules that you guys have for when something might trigger, it raised 500 million pre?
Yeah, so the rules we go by are, I would say, let's ignore the bubble time for a second. And the rules are generally, we're about ultra-diversification and risk management, right? Ultimately in our portfolios, it's like, how can we get a consistent 3 to 5x return to our net return to our investors in almost all macro environments? And part of that is this high returning segment investors ignore, ultra-diversification. So if one of our positions starts to grow so large that it's a disproportionate amount of that fund's NAV, then if that company is having a next round, we'll often look to sell part of it into that if we can. Sometimes, like we had in our first fund, our largest position, the company became wildly profitable and was never going to have a next round. So actually, we sold half of our position and then the rest of it in 2 different transactions that we manufactured the liquidity. Like there was no round. It was all secondary sales and we ran our own processes. So it depends. And then you get some unique times. Like I'd say myself and both my other 2 partners, we've all been entrepreneurs and, in and around the tech world since the 90s. So we've been through, I was in San Francisco in the first dot-com bubble, expanding and popping. We were around in 2008. And so I think all of us had much more of an appreciation in 2020 and 2021 that we were in a bubble. Like we had no way of predicting when it would end and how big it would inflate, but we were sort of in the mindset in 2021 of sell everything that's not nailed to the floor. So we definitely had some companies going off of crazy multiples that were still early in our fund's life cycle, and we still sold some positions.
Good on you. I think a lot of investors.
And then fund life cycle makes a difference too. Like as we get to years, 8, 9, 10 in a fund's life cycle, even if that position isn't a huge part of the NAV, if we can sell a position at fair value, we're going to sell half of it or maybe even all of it.
And so a couple of things I want to touch on there, but I want to circle back a little bit to how your historical knowledge of seeing different boom bust cycles and equating that to today with AI, up and coming and the goal being reduction of costs to scale a company. How are you anticipating the market continuing to evolve as more companies adopt AI, which should inevitably reduce their costs?
Yeah, I mean, so I'd say the most amazing trend we've seen since we started investing is interesting. Up until a couple of years ago, the main trend was a reduce in the cost to build a first version of a software product. And really, this is something that's been trending down since the 1980s, right? It might have taken $30 million to build a first version and prove if you could sell it in the 80s. And maybe that crashed down to, it was just low millions in the early 2000s. And I remember back then we thought, my God, it's so cheap now to build software. But, it's probably down to $1 million in 2010. And that helped spawn, what was called the super angel, investor movement, which became sort of micro VC, seed and pre-seed stage investment world exploding. But between 2000 2010 and 2016, the cost to build a product just collapsed. It probably went from an average of $1 million to 100,000. And if you're technical founders, it could be zero. And what's interesting in this time, during that whole 30-year period, the cost to build your first version of your product went down, but the cost to scale it up and run your operations never did. Like the cost for marketing and to scale out sales and all this was always the same or going up. But AI has changed that. Like what we've seen within our portfolio and in new companies we're looking at is all these AI tools are making companies so much more operationally efficient internally. And suddenly now there's the shift. It's not just cheaper to build the first version. It's those initial stages of scale. You can do more with less people. And so that's just incredibly exciting for us. Like we're seeing profiles and opportunities we've just never seen before. And a lot of it is because these teams are able to leverage AI and, hey, you can do stuff with 5 people that you would have needed 12 people for maybe just a few years ago. And we had not previously seen that. So it's really exciting.
I'm curious to see how it's going to influence our stages at the growth stage, Series B and beyond, as companies, could potentially ship an MVP with one person in a matter of weeks instead of
like we talked internally. We're like, hey, it's possible that between now and 2030, we have 2 or 3 companies we invest in that become billion-dollar companies, like with less than 100 people in them, or maybe even less than 40 people. It could be, we'll see. But we're starting to see some shoots of a few companies that we think are on that path and that potentially could happen. And that just would have been almost impossible, like just a few years ago, and certainly in the 2010s. Like can't say it never happened. Instagram probably, sold for $1 billion when it was really low, but it was such an anomaly. And that could become more standard fare. Yeah, and that could very much change later stage investing. What if companies don't need as much money?
Yeah, I would say Instagram would be maybe a positive black swan.
Yeah, exactly.
One of the very few that, we all hope to hit one, but it's going to be extremely rare. So, you've been around, you've seen a number of cycles, as I already mentioned. I'm curious, you're raising your 3rd fund, correct?
Our 6th fund, right?
6th fund, I'm sorry.
Yeah.
Fund today. How have the fund sizes changed over time?
Yeah, they've gone up. So our first fund was a $6.5 million proof of concept fund. We did 279 investments, and it went exceptionally well. That's returned 6x back to investors already, and will probably be a 7x fund. 7.5x fund. Our funds 2 and 3 were 16 and 17 million. Our funds 4 and 5 were 33 and 34 million. And our fund 6 will likely be, we're sort of on track for 50-ish. Could be anywhere from upper 40s to 60s, depending on pipeline. But in today's world, it's so hard to raise in the venture capital world. So few LPs are deploying capital. We discount our pipeline down lower than we ever have.
Well, I was going to say there's also been a bifurcation, I think, in the venture capital world between massive funds, we know them all, and smaller ones that are a lot more nimble. And so, is there, you could almost argue that there's a reason that you kept fund sizes small so you can be a lot more thoughtful about where you're investing and not be forced to deploy bigger checks, considering the thesis of the fund, right, where you don't have ownership mandates and you don't want to, hold through exit. And so you don't want to be an influential partner.
We would never change the fundamental strategy of what we're doing. So we believe we could actually probably scale up and deploy up to 100 million a year, but we would not change the profile of round size. Like we would not suddenly go from investing in 200 to 500,000 rounds to 500,000 to $1 million rounds. We might go from being a 220K average tech to a 370K average tech, but we just do a lot more deals. At our stage, it's very interesting because there's just not finding the attractive companies to invest in is like item number 5 on our plate. Like for most of the venture world, it's so hard to find attractive companies. And at the stage that we operate in, we have almost no professional competition. Like most, even pre-seed funds, there are pre-seed firms that write 250K checks, but almost none of them would write 250K check into a 250K round. Like that would be terrifying. Or even in a 500, they're 250 into $1.5 million round. Because the cost to build a software product have gone down, the supply and demand has gone like out of whack, more in our favor every year we've been around. So it's a weird dynamic. It sort of doesn't exist. Once you get to the traditional pre-seed and beyond, it gets very competitive in a venture world. Not as much today because there's less people deploying capital, but in all sort of normal times. But to answer your question, go back to what you said. Yes, like there's a huge bifurcation. in the venture world. Like all the money is being sucked up by the Uber funds,
We see it. Absolutely, we see it. So, been around since 2012. How are you finding founders, or how are founders finding you at such an early stage? And there's a second part to that question, but I'll start there.
There's no dominant channel now. So that was trickier in 2012 and 13. But fortunately, the entrepreneurial world is one of the most, networked and social media, technology savvy crew out there. So the word gets out pretty quickly. Maybe I'll just go over like what it is today, like where we get the mix of how we get our deal flow. And you can sort of understand how some of those exist now might not have existed when we started. So today, it's a mix across a lot of things. I would say the accelerator world is a big part of what we do. So we're actually minority owners and capital deployers into a handful of startup accelerators where we both get early checks in, and then we're meeting with every company as an owner already, a week or two into the program, and getting early access to write additional checks into those companies. We also work with a lot of other managing directors at a whole variety of accelerators. And most startup accelerators, the model is you show your companies to investors at demo day, right? Because you don't want the companies to be distracted. Well, because we're a really quick yes or no, usually in just a day or two to a week max, we don't distract the companies mid-program. So we're often introduced by managing directors to companies, in the first month of a program. And we get to look at them and invest when they're sort of not out there raising. The second thing is this enormous next round investor network we've built out. So we have a person on board who's most of what they do, they've built out a network of about 1,400 venture capital firms, anywhere from pre-seed to late stage private equity. And at every stage of our company's life cycle, whatever their next round is, we keep track of what those investors are focusing on at that point in time. So a lot of interaction with them. And we send that company out to whoever the 40 to 140 appropriate investors are. So that huge network of investors also is constantly seeing things that aren't too early or looking at too small checks for them, and they're referring stuff to us. We also have just an enormous brand right now. So I'd say our biggest source is just random people coming to our website, reaching out via email, LinkedIn, and that's because they talked to 2 or 3 founders who know about us or took money from us. They did a search for, you name it, the most active early stage investors in Texas or something. And even though we don't focus on Texas, we might be number 4 on that list or 3. It just will, come up and our name's out. We've been in a lot of articles or podcasts or things like that. Deep personal network. And then the last, which didn't exist when we started, but it exists now, is we have 2,000 or 3,000 active founders right now that are scouts on the ground for us. And they send us their network and friends and people they run into that are investing. So I would say our deal flow is pretty much equally spread across all those in today's world. There's no dominant channel. But obviously that founder scout network and that brand, none of that existed when we started investing. So that's a big moat that we have that you can only build out over a long period of time. That's not really, if you started from scratch now, it might take you a decade to build that.
So if you're making decisions that quickly, is there a human in the loop? Is that a lot of that being run by, essentially an algorithm that you have built?
There's a human in the loop. It's interesting. Before we started, when we built all of our systems and processes, we said, all right, what would we want to look like? And what would it look like if we could invest in 1,000 companies a year? So we thought we wanted to build something that could scale up large. Now, we've never invested into close to 1,000, but we actually had some technology that we created even in 2011, where we could have founders fill out an interactive PDF form online about the founders and the company and submit it, and it would automatically kick out, would we invest, and if so, at what valuation? But we realized we didn't need that as much. Here's what's happening. In a plain English description, here's what I've realized over time, the incredible difference between what we do and what I did as an individual angel investor and what every other angel or venture capital firm does, which is if you're an individual investor or venture capital firm and you are doing diligence on a specific company, you're actually trying to predict if that specific company will succeed or fail. Like that's what everyone's trying to do. And we don't do that at all. What we do is we turn a company into a profile. And then we say, all right, if we invest, our algorithm and thought process built around the question of if we invested a pool of 50 to 100 companies of this profile at this price being a very important part, which it generally isn't for venture, how would that pool perform? And if we think that pool of 50 or 100 of this profile at this price would perform really well, we're investing. So that's sort of fundamentally, in sort of layman terms, how it works. And when you look at the world from that perspective and make investment decisions, it's an entirely different process and you come to different conclusions. So what we did then is we also engineered out of our process the ability to do subjective analysis that we don't want to do. So we're not allowed to consider whether we think an idea is insane or crazy. We can think what we're investing in is nuts, but if the unit economics are there and the math works out, we're still investing. One of the reasons why is that we think the difference between ridiculous and revolutionary at this early stage is zero. And in fact, if you try and screen out the ridiculous, you probably screen out the revolutionary.
I love that line. And it makes my next question kind of moot, which was about what is a venture backable business versus what isn't. And if you're taking a group of companies as a pool and almost diversifying within each pool, we talked about power law before, you're bound to hit a couple in there, which would, essentially diversify away from the ones that don't hit.
Yeah. Like if I give an example of our biggest winner from our fund one, any investor that did sort of the traditional subjective venture analysis would have run screaming from this company. So I'll describe the company. It was a financial charting technology software company whose target customer was high volume at-home traders who traded stocks, commodities, and currencies. And it was a freemium business model where the very, very little few percent that paid $15 or $30 a month. So like from standard venture analysis, everything about this would make you run screaming. It's like, that sounds like an incredibly small market. How many active at-home commodity and currency traders are there anyway? And the freemium model sucks. Like you're only getting a small percentage to pay. And they're not even, it's like the few that pay aren't paying you $200 a month. They're paying you an average of $20 a month. So there is no venture analysis that would lead you to think I should invest in this company. But we looked at it and actually ended up writing it our largest check at the time. How did we look at it and what was our different takeaway? So what we looked at is we said, all right, how much revenue does it have? And the answer at that point in time is almost every company had zero. This one actually had 12K MRR, incredibly unusual for that time. How much capital have they raised to date? Turned out it was zero. This company had bootstrapped the company up there. Incredibly unusual at that point in time. This was in 2012 or 13. Most companies needed 500,000 to get a product live, if you were capital efficient. How much cash was the company burning? Well, it was actually break even there because the founders were from Ukraine and Russia and they had a team, even though they were based here, they had a large team of engineers in Ukraine and Russia working on it. And the founders had massive domain experience. Like the two main founders had something like 12 years each of financial charting software development. And when we talk to people, I don't know what makes great financial charting software, but everyone is like, their technology is better than everyone's. So from our perspective, it's like you got a team that's bootstrapped something up to higher revenue than you normally see. They're break even. They've got a lot of domain expertise and they've got this crazy low operating structure. And, because they have all these overseas people, we're like, if we invested in 50 or 100 of those that were at 12K and it was at $3 million valuation, we're like, that would crush it. I don't care what the companies are doing. So we, on the spot, offered them an extra 100,000 at $3 million, and they took it. And that company is TradingView, which is a very large,
Doing quite well.
company that's doing quite well now. But in foresight, you could never predict that. I mean, and it's not like we thought, oh, this one's going to crush it. If you had asked us at the time, on a scale of 1 to 100, like how likely is this to be a $1 billion company relative to the others in your portfolio? We probably would have put it in the bottom 15%. Like we thought, all right, this could be a good outcome, but it just didn't seem the right profile.
The amount of successful companies that, like I've talked to some really, really early angel investors. Pinterest just comes to mind as one where a lot of people that I know passed at the first stages when they were in the accelerator program because the business has to pivot a couple of times. You can't imagine where it's going to go. And sometimes you got to take those bets.
Here's the funny thing. When we were doing research, like in the initial years before we launched, one of the things we did is we tried to find as many investors as we could who had a personal portfolio of more than 100 investments, whether it was like an really early stage venture firm or in particular active angel investors. And we ended up coming across probably 12 or 13 angel investors across the country who personally had invested in more than 100 companies. And every one of them had the same story. It was amazing how consistent it was. Most of the companies failed, went to zero. A very small percentage were wildly successful. And almost universally, they said to us, my biggest winners are the ones I put my smallest checks in because they're the ones I had the least confidence in. And universally, the ones I put my largest checks in tended to do worse. And it was amazing how consistently we heard that from investor to investor. And that's what happens when you try and put more in the revolutionary and less in the ridiculous. Maybe you're doing it the exact wrong way.
We have those conversations at the growth stages too. It's sometimes your holds are your best ones. And if you're going to have conviction to make an investment, you should invest. So we say, make a cannonball. Just go into the deep end.
Yeah. I mean, one of the nice things is if you invest in something that seems crazy and it works, that company might have a 2-year period to operate with no competition because no one else is trying it, right? If you invest in a space that everyone agrees and thinks is hot and this thing is needed, at best, you have a 2-month head start, and then you're going to have 8 competitors, So it's just really hard. Human brains aren't wired to factor in that so much of this is unpredictable. I mean, we can't predict the weather very accurately, 2 weeks out. Nobel laureate economists can't predict the economy 6 months out. I'd argue there's more variables of uncertainty in an early stage startup, and yet every early stage investor pretty much convinces themselves that they can weave a story and predict the future. And it's like, I understand it because I've lived my whole life in tech. Like all I've done from when I was 22 to now has been a tech CEO or an investor. So I psychologically feel like that should give me more ability than almost anyone else to make these subjective judgments and predict into the future. But I also know that the data shows that I feel that, and I'm probably wrong about it.
There's the reason Renaissance Technologies is outperforming the market almost every year.
That's a very good point.
No human bias in there. So you're on Fund 6. You've been a technologist your whole life, but I'm sure there have been learnings along the way. And so I want to end our conversation with this question, which is, what is one piece of advice that you wish you had been given when you started your journey into the private markets?
Boy, into the private markets. It's such a longer game than you anticipate going into the private investment space. I mean, you're launching funds. They take a decade plus to play out. The reality is you don't know for years if what you're doing works or not, or if you're good or not. And it seems like the easiest job to do, like when you're not doing it. And I think, every entrepreneur out there is like, oh, I could be an investor really easy or a person like this. And then you do it and it's incredibly hard. You have to work incredibly long hours and you have to work for what seems like an eternity for you to actually get your own unit economics out. So, I guess I knew all that in theory when we started, but in principle, when you do it, it's a much longer journey and you have to love what you do if you're going to embark on something like that. So to anyone who wants to jump into the space, you can't do it because you think you're going to make money because you're going to be doing this for so long. You've got to love it. And if you don't love it, it's not going to be good for you. So I love what I do because I love being an entrepreneur. I feel we're sort of being an entrepreneur right now. Still, we view ourselves as a tech startup whose business is funding other tech startups. But I also get to interact with entrepreneurs all day long at all different stages. And I get excited to get up every day because of that. Even as painful as it's been with the bubble popping in these last couple of years and so many of my conversations being about laying off people, how are we going to survive? All right, how do you wind down and all this? It's painful, but I still love what I do.
And luckily you get multiple shots. You make the root decision to not continue to chase on costs and you can, find the next idea yonder, then there's always more opportunities.
That sunk cost chasing, boy, that gets people. I mean, as a parting thought, like just an observation that we've had is because we didn't have a recession and we still haven't for 15 years. I don't even count COVID. Almost the entire startup world and investor world has never been through a downturn or a valuation collapse before. And because of that, I think there were just so many unforced errors because you had a lot of companies being run where nobody at the senior levels of the company and nobody on the board had ever been through a major downturn or a valuation reset. And that's, hasn't really happened before. If you go back to the 90s, 2000s, there were recessions every 4 to 7 years and people had been through it. And I think a lot of people just didn't know what to do. And there were probably a lot more unforced errors than we realize.
But you keep grinding and eventually you'll be right a couple of times.
Yeah, exactly. And I think this culling of the venture world is healthy for the ecosystem. I think the venture world had grown too big. It's painful for the VC world. It's painful for us as we fundraise. It's painful for startups as they fundraise. But I think net, it's really healthy for the ecosystem long term.
Well, with that, Dave, I really appreciate your time today. Really appreciate you joining the Driving Alpha podcast and excited to see, what comes next out of the portfolio.
Yeah, great talking with you.
Thanks for listening to the Driving Alpha podcast, where we host top investors to demonstrate how they outperform the market. Click subscribe so you don't miss future episodes. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.